All right, in the world of digital health, there are two titans on what looks like a collision course: China's Ping An Good Doctor and America's Teladoc Health. Now, their 2025 reports just dropped, and wow, they reveal two wildly different playbooks for the future. So, as analysts here at HDIN Research, we're going to dig into the numbers and show you what's really going on behind the headlines.
Look, let's be real. The pandemic-fueled telehealth gold rush? Yeah, that's over. The game has totally changed. It's not just about growing at all costs anymore. Now, it's all about building a sustainable business. So, the billion-dollar question is, which one of these giants is actually built to last?
And that really gets to the heart of what we found. Our research pinpoints 2025 as the watershed year. This was the moment their paths didn't just diverge, they practically split onto different continents. So let's start with the basics, their core strategies.
First things first, we got to understand their blueprints for success. They are fundamentally different. It's a question of, are you a self-contained ecosystem or are you a global specialist?
So on one hand, you've got Ping An Good Doctor. They operate inside what we call a walled garden. They are deeply, deeply embedded in their parent company, Ping An Group, which is this massive insurance and financial services beast in China. That integration creates some incredible synergy. Then you have Teladoc, which is the complete opposite. They're the global supermarket, the world's largest standalone virtual care provider, offering a massive menu of services to pretty much anyone, anywhere.
And this chart, it drives that walled garden idea right home. Just look at that. Over 40% of Ping An's revenue comes directly from its parent company. That means a built-in customer base and ridiculously low cost to acquire new users. But, and this is important, it also raises a huge question about dependency. We're going to come back to that.
Now, in sharp contrast, Teladoc's power is all about pure, unadulterated scale. We're talking over 100 million members. That massive B2B base is the engine that lets them spread out their tech costs and just dominate the global stage.
Okay, so we've got the strategies down. Now let's follow the money. Because the financials are where these two blueprints lead to some dramatically different places. You could say 2025 was a tale of two very, very different profit lines.
Now, on the surface, Teladoc is the undisputed king of size, right? The revenue is more than 3 times Ping An's. But, and this is a huge but, look at the growth trajectory. Ping An is growing at nearly 14%. Meanwhile, Teladoc's revenue actually shrank by 2% for the first time ever. That was mostly due to some struggles in its BetterHelp division.
And here it is, the bottom line. In 2025, Ping An's ecosystem model delivered its first ever annual profit. That is a massive milestone. Teladoc, on the other hand, posted another loss, $200 million. And that staggering $16 billion accumulated deficit, well, that's the long-term price tag of its aggressive, acquisition-fueled growth strategy.
But you know, it would be way too simple to just stop there and say, profit good, loss bad. As our research concluded, this is a much more nuanced story. It's a story of a paper loss versus actual cash generation. Let's break down what that really means for Teladoc.
Okay, quick accounting 101, because to really get Teladoc's financials, you have to understand something called non-cash charges. These are basically accounting entries for things like paying down the value of past acquisitions. They slash the profit you see on paper, but, and here's the key part, no actual cash leaves the company's bank account.
And this is the aha moment in their report. Despite that $200 million paper loss, Teladoc's day-to-day operations actually generated nearly $300 million in cold, hard cash. What that tells us is that the core business is actually pretty healthy. It's the accounting ghosts of those past acquisitions that are dragging down the reported profit.
So that operational health for Teladoc and the newfound profitability for Ping An, they're both being powered by the same engine, technology. In 2025, AI stopped being this flashy buzzword and became absolutely essential infrastructure for both of these companies.
And it's really cool to see them using AI in two different but equally powerful ways. Ping An used its AI models, which have been trained on almost 1.5 billion consultations, to just slash its cost per visit by 45%. Teladoc, meanwhile, leveraged its AI to improve service, matching 90% of its urgent care requests with a doctor in under 30 minutes. So one focused on cost, the other on speed.
But even how they invest in that tech is different. Ping An spends more on R&D upfront as an expense. Teladoc, though, did something called capitalizing its software costs, nearly $119 million worth. Basically, they moved it from an expense to an asset on the books.
This makes short-term profits look a little better, but it guarantees those costs are going to pop back up later and drag on future earnings for years to come.
So let's bring this all together and take a look at the road ahead. Because based on everything we saw in 2025, they are facing two very different strategic challenges moving forward. And this brings us right back to our original question. After digging through all the numbers, the strategies, the tech, which of these giants really seems better positioned for the next chapter of digital health?
At the end of the day, it really boils down to this. For Ping An, the challenge is clear. They've proven their model works beautifully inside that walled garden. Now they have to prove they can win customers and grow on their own in the hyper-competitive outside world. For Teladoc, the challenge is twofold. They have to keep managing the massive financial hangover from their past buying spree, and, maybe most importantly, they have to find a way to get their revenue growing again.
And one final note from us. This has been an independent HDIN research analysis. It's for educational purposes, and it is absolutely not financial advice. We're here to cut through the noise so you can see the signal. Thanks for joining us.